Federal Reserve is expected to cut borrowing costs when it meets this Wednesday, and the Fed's expected to give us one final quarter-point rate cut this year. Joining us now to talk about what this could mean for Americans is Ted Rossman, Bankrate Senior Industry Analyst. Welcome.
Good to be here. Thank you.
So what is sparking the Fed's rationale for cutting rates?
Inflation's coming down, so that's a good news. The Fed doesn't need to restrict the economy as much. So they pushed rates higher by 5.25 points in 2022 and 23, really an effort to fight inflation. You make it more expensive for people to borrow money. That brings inflation down. The job is not done, but they're at the point now that they can start taking their foot off the brake.
And, you know, what are you going to be watching for when Fed Chairman Jerome Powell makes his announcement? The
projection for next year is what's going to be most interesting. So every other meeting, the Fed meets every 6 weeks, but every other meeting, they give us a detailed summary of economic projections. Basically, committee members plot out where they think interest rates are going in the coming years, unemployment, economic growth, other key factors. The quarter-point cut this week, we pretty much know that's happening. Next year, though, there are a lot of open questions. Maybe it's a half a point of cuts. Maybe it's 3/4. Maybe it's more. Maybe it's less. That's really what we're most going to be watching for.
And when Donald Trump takes office next year, and we're talking, tariffs impact, so how is it going to impact the Fed's monetary policy?
Well, we've already seen it with some of the longer-term rates that are set by investors. So the Fed sets short-term rates. Long-term rates are more dependent on the markets. And we've actually seen long-term rates go up in the weeks following the election. Basically, there's a feeling that some of President-elect Trump's policies could be inflationary. Things like tariffs, deficit finance tax cuts, lower immigration. Investors are betting that that may be inflationary. That may require higher rates. And that's actually one of the reasons why when the Fed gave their last projections, they thought maybe they would cut a full point next year. And now the best guess is maybe a half a point. So really kind of reading those tea leaves and thinking, where is the economy going? Where are interest rates going? Now, the economic data has been better than expected, so that's a good thing. But there is a fear that some of these other policies, especially tariffs, could be inflationary.
And let's talk about how this rate cut will impact, home buyers. Should wait? Do it?
We got a big head fake on mortgage rates because last fall they briefly hit 8%. So I'm talking about the 30-year fixed rate mortgage. The average briefly hit 8% last fall for the first time in 2 decades. And then it started to come down, actually went as low as 6.2% in September. And that was when the Fed started cutting. So everybody was like, oh, this is great. Rates are down. They're going to go lower. As I said, though, mortgage rates are more dependent on the long-term bets that investors are making. And the trend is actually reversed. So even as the Fed has been cutting short-term rates, long-term rates have gone up for some of the aforementioned factors about some of the Trump administration's likely policies. And also the tone of economic data has been pretty good. So in other words, the average 30-year mortgage has gone up to about 6.8% at present. And it's a tough time for home buyers, to be honest. I mean, rates are high, prices are high, inventory is low. Unfortunately, we're not seeing as much progress as we wanted.
So overall, I mean, looking into 2025, how do you see the housing market?
It's still going to be slow. Now, we are getting used to these higher rates to some extent. I mean, a few years ago, you could have gotten a 3% rate, which is actually part of the problem because the current owners have those kind of golden handcuffs, if you will, that they don't want to trade their current 3% rate for one that's 7. And by the way, whatever they're buying is going to cost more. So, that's kept inventory low. It keeps prices high. People have to move for other reasons, too, of course. It's not just the economic factors. It's jobs, it's families, it's other things. Some first-time buyers are saying, you know what, I'm sick of waiting and I'm going to jump in. It's not the best time to buy a house, but if you check those boxes, if you have enough money for a down payment and a cushion for maintenance and repairs and you're going to be there a while, you could always refinance in the future. I mean, I wouldn't put all my eggs in that basket, but there is a feeling about marry the house, date the rate. You can always change the rate later on if market conditions change. So, we're starting to see a little bit more activity, but it's still pretty slow going.
And with the latest consumer spending data, tell us about the economy.
The economy is doing better than most people realize, and that's really the silver lining here. People don't feel great about it because of inflation. Prices have gone up 20% since the start of 2021, and wages have only gone up 17 on average. That's why people are not feeling great. But when we think about jobs, GDP growth, other key economic data has been pretty good. The holiday shopping season is off to a solid start. We actually just got November sales data, and those sales came in better than expected. They're up about 4% year over year. Consumers are actually doing better than they feel, but inflation is still holding people back. There's a cumulative toll. Inflation's come down, but prices are still growing. It's just the rate of change is not as fast.
Well, I like hearing that we're doing better than we think. Ted Rossman, thank you so much for laying everything out for us. It gets so confusing, so I appreciate it.
My pleasure. Thank you.